It's time to step up the game, Greg, because it is time to go live on Facebook for the Not Your Average Investor Show, Tuesday edition. I am your host, Pablo Gonzalez. With me, as always, my co-host, the man they call GC, because he's here to generate clarity with incredible numbers for you, and because his name is Gregg Cohen. Say hello, Greg.
What's up, my friends? How are you doing out there, Pablo? I was blown away when I asked you to bring the A game. You brought the A game to the hype man that you are. Way to go, brother.
You like this one right here?
People are just going to be tuning in to see what you do next week.
I don't know, man. I don't know if it's tuning in to see what I do, what we call you GC, but it's great. It's great to be here, man. What you were talking about earlier before we went live on Facebook about, this like feeling of this show being a real thing. It's so surreal, but it's so real, right? Like, welcome John Henning, welcome Leo, welcome Jackie, welcome Lee, welcome Louis Visco from Northern California, beautiful part of the planet. I can't describe how much fun it is to have this moment every week to share with people, to get to pick your brain, to get to, help people out, spend some time together. And for those of you that are coming for the first time, welcome. We hope that you stay and you become part of the family and become some of our regulars. Our regulars know that this show is driven by interaction, right? We want you talking to us. We want you getting questions answered by Greg himself and getting answered wrongly by me. And there's two ways to do that. One is to use the chat, and that is when you pop it up on the left-hand side. When the text box comes up, it is defaulted to only showing your words to us. But you got to hit that panelist button, drop that down, make it panelists and attendees. And that way everybody can chat. You can make a new friend and you can tell people where you're from. In fact, go ahead right now. Jackie, you're only talking to panelists. Jackie, go ahead and put all panelists and attendees. Let us know where you're coming in from, Jackie. And we'd love to know. And as you'll see, the chat moves a lot, right? Because people are interacting with each other, making friends, answering questions, lots of value in there. So if you want a question answered on the show live that we then, you may make it into the JWB social media stream later on. You pop open that Q&A and you put it in there, right? And the reason why I ask you to use the Q&A is because the chat moves really quickly. The Q&A stays there, right? So I can really, really keep track of it. Welcome, Samantha Lupo Lebaskov from Texas. Howdy.
There it is. There's the one person every single time that Pablo butchers their name. Way to go. Now you're a veteran.
Got it out of the way. It's like a boxer. I got to get punched in the face one time and then I'm ready to fight. So I encourage you to use that Q&A if you want a question asked live on the show here. And last but not least, if you're new and you want the breakdown for what rental properties can be for your, rental portfolio, understand like the three really key things that you really, really need to understand. Go to jwbwebclass.com, spend 20 minutes with Greg, who put it together for you. Really informative. And you get to download the free investor toolkit. And of course, if you want a more personalized time on the phone with our team, go to chatwithjwb.com. That's what we're here for. Answer your questions personally, create a game plan for you and your financial goals. And speaking of financial goals, today we are talking about the Jacksonville real estate market, Q4, some eye-popping numbers. Greg, are you ready to tell people what the real estate prices are doing now and what we think they're going to do?
Pablo, I'm ready to jump into the Q4 market update, brother. Let's go. I've been waiting all night and all day for this thing. Let's do it.
All right, man. What are you seeing right now? Talk to me about the supply of housing in Jacksonville right now and what is going on. To me, that's the main story, right?
It is the main story. It's been the main story for, this year. It's been the main story for the last 6 years. Right? What happened during the Great Recession and the pricing declines that happened forced builders to run and hide. It basically brought building to a halt. And since then, we have been in a low supply environment. And we'll look a little bit at the numbers here as we get into this. But the big picture here is that it's been a low supply environment for a long time. But what we're going to see here when we look at some of the numbers is that the supply has never been lower and the demand has never been higher at the same time. And it's creating this environment where prices are rising, right? And in the midst of coronavirus, where the world is really on fire, it's a very unique, there's one segment of industry that has continued to be on fire. It's been on fire here in Jacksonville. It's been on fire in many other places in the country, and that is housing. Housing is continuing to increase in value, and the reason is because of low supply. That's the greatest reason. Actually, there's a number of reasons. We'll get into those, but the biggest reason out of all of them is something that you just can't solve quickly. You just can't build enough houses quickly to solve the inventory problem, the supply problem. And when I say it's a problem, that means that low supply, high demand equals rising prices. And that's what we're seeing. So you brought up a really awesome slide there, Pablo. Where'd you come up with that one?
My friends at the NAHB just sent it over to me. I got it via text, so I figured I'd share it. Listen, you're talking about painting the picture, right? So I wanted to put here the picture itself that you shared with me earlier, where, as you all know, I'm going to talk through it a little bit because we repurposed this into podcast. So we want a friend that's listening in his or her ear right now to understand what we're talking about. But it starts in the 1960s and it goes every decade through the 2010s. And it goes basically from per million population average of housing supply. And it goes from 47,998. It goes slightly up in the 70s, slightly down to 41,000 in the 80s, stays around 41,000 in the 90s, stays around 41,000 in the 2000s. And now in the 2010s, it's at 21,288. Greg, I just kind of twisted my tongue there, but what is that actual number? 21,288. What's?
Those are the number of housing starts per million of population. And really what we're measuring here is, do we have enough houses being built to support household formations, right? Household formations are people are having babies, people are getting into the world and getting their own place instead of living with their parents. You need houses to support household formations. And through that chart that we were just looking at, we were seeing that we had, call it roughly about enough household formations or enough housing starts to support household formations going back to the 60s and 70s and 80s and 90s and 2000s, right? It was always between, call it 40,000 and maybe 50,000 starts. Well, in the 2010s, as we're pulling the chart up here, yeah, you can kind of see it was always between 41,000 and 53,000 for, 5 decades there. Well, in the 2010s, it was cut in half. We had half the number of housing starts per million of population. And that means that we just simply did not build enough. And that makes sense because as housing prices crashed, builders are not going to build something if they can't make a profit. And it's expensive to take raw land, develop the land, and then go vertical on it and build a house. And there's no builder in the world that is going to do that at scale for free, right? JWB, we did that and we gave the house away. We've done that each year actually as a charity event. We gave that to a wounded warrior. We gave the house away for free. But you're not going to do it more than once or twice, right? A builder is only going to build if they can make a profit. It wasn't possible when the Great Recession happened. And that is the force that has been with us for a long time. It will continue to be with us for a long time, right? That's why when coronavirus hit in the beginning in March, we came strong. We said, we just didn't see prices falling. The core of that was we had a supply problem. We had low inventory. And you just can't solve that overnight. And that's why we felt very confident that prices were not going to go down. That's why JWB continued to buy our own properties, even in the face of coronavirus. And we recommended to our clients to continue to buy because we see the opposite happening. Because you have low supply, prices are continuing to go up.
So let's dig into that, how that affects your decision making slash what it means for your positioning that you've already done, right? So you look in the 2010s, everybody stops, they get freaked out by the Great Recession. And there, at some point, I think it was like 2-3 years later, was it that JWB came up with the model of build to rent, right?
Well, we started building new construction in 2011. So yeah, if you think the market started to crash really in 2007, 2008 really started to crash 2-3 years later. That's when we did build to rent.
Yeah. So you started doing build to rent. I also happen to know that you go hard at acquiring land lots so that you can foresee inventory for the next 3 years.
Mhm.
And I just want to ask, as a land developer, right? Like you are no longer just a house remodeler and flipper. As a land developer, that long-term turning of the cruise ship into starting to develop land, how quickly were you all able to implement that kind of change, right? Like if someone's seeing this data right now, it's like, oh my God, I got to go ham at Jacksonville construction houses. Like how much of a buffer, do you estimate before anybody can actually make a move and take advantage of this stuff if they're not already well positioned for it?
So are you thinking about it from a developer's perspective, or are you thinking about it from a client's perspective, meaning somebody who's trying to own cash flowing rental properties in a market like this?
Yes. I'm thinking about it, right? Like I'm thinking about it as myself, right? Like I just invested in a JWB home, right?
Mm.
And I am wondering that if JWB, and since JWB is out and has created this moat of land and foreseeable inventory around that stuff, for how long can I just straight up bank on the idea that nobody's going to really realistically be able to change this market before other market forces may or may not take into account, only isolating that variable?
Gotcha. So now making sure I understand this. So now you're saying, okay, well, if the market dynamics are the way they are, how long is it going to take for the inventory problem to be solved, basically to where the market may change?
Essentially.
I don't know. I don't know. This year, building, the number of starts has been on fire, right? Prior to coronavirus, building was on fire, right? So many permits pulled, so many new houses going up. When coronavirus hit, there was a temporary, like, what the heck is going on moment for, land developers and builders and whatnot. That lasted for like, call it a month. And then since then, it's been on fire again. So if you just looked at today, are we building enough to support household formations for the year? I don't have that data, but I'm guessing we probably are, right? But you're making up for almost a decade of not doing it. So
Mhm.
I don't have numbers on this, but in my mind, it might take, a decade of overbuilding to get back to a point where you're actually able to solve the inventory problem. Now, don't take that as, anything more than me just looking in the past and then, using my rough idea. I don't have numbers to support that. I don't know if it's going to take a decade, but it's not going to be solved overnight, right? The best thing to do is to look at months of inventory, that tracking right there, and see how this is playing out on a monthly basis. That's what we've learned. And that's why we have tracked months of inventory, which answers the question that you had, Pablo, is do we have enough supply to support the demand? You look at that and you can kind of see where it's going over the next 6 to 12 months. But one thing I do know is I know we're going to be doing this show for the next 100 years, Pablo. And I do know at some point here, this will completely turn and we will have overbuilt again because this is what the real estate market does. And this is what home builders and home developer and land developers do. This is what we do. But this is probably the low point, as you're going to see in the data here, from a months of inventory perspective, where you have low supply, really high demand. And so it is very clear in the very near future that we don't see prices going down.
Okay. And let's jump right into months of inventory data, Greg. So I'm going to pop up the stats on months of inventory and tell me what this means, right? Like I'm going to speak through it real quick for our friend listening on a podcast, right? So Jacksonville housing months of inventory data, inventory on market. October 2019, there was 8,728. Is that homes for sale?
That's homes for sale on the market. Yes.
So 1 year ago, there was 8,728 homes for sale. And now August, September, and October of 2020, there has been between 5,700 in August, and it's gone down to 5,296 in October. The total sales at that same time, while the inventory is dropping, while the amount of houses available is dropping, the total number of sales have gone from 2,479 in October to 3,193, basically right around 3,200 for August 2020, September 2020, October 2020, right? So that is an extra 700 houses that are being sold monthly right now in Jacksonville. It represents about a 30% jump, right? Like between a 25% to 30% jump in sales year over year. And now this months of inventory figure, Greg, that I'm hoping that you can explain. Why don't you explain what months of inventory means? And then we're going to talk about these numbers.
Yes, absolutely. Months of inventory is a great leading indicator for where pricing is going to go, call it over the next 6 to 12 months. And the best way to think about this is like any business that you may own, right? If you're a business owner and you have low supply and you have really high demand and people are buying a ton of stuff, you had a bunch of sales last month, but you don't have a lot of it, you're going to have upward pressure on your pricing. And the opposite is true. If you are a business owner and you have a ton of widgets, you have a lot of supply, and nobody bought anything last month, you're going to have downward pressure on your pricing. And it's the same way in the real estate market. Looking at this data along with other data points, this isn't the only one, but this gives us the confidence to know where we think the market is going. And the great thing about real estate and rental properties is that you can make profits, you can make money in any market. You really can. But if you know what's coming down the pike, that's where you can really be at an advantage. So the history shows us that an equilibrium market is between 6 to 7 months of inventory. And so just like you were showing on the graph there, when you have a certain number of months of inventory, you just take what the number of homes that's sold in the previous month, and that's how you determine what your months of inventory is. And then we look at it every single month. This is what we report on for our clients. We do this quarterly call for all of you as well. And if we're below 6, that's telling us that it's a seller's market. That means that there's upward pressure on pricing. And the lower you go, the more upward pressure on pricing there should be, holding everything else constant. And if you go to the other side, in fact, if you look at the very bottom there, I put just to put a dose of reality, like, because people lose perspective unless you were there investing in 2007, right? The other side is true. If you go way above 7 months of inventory, the farther you go above 7, the more downward pressure you're going to see. And that doesn't mean just because you get to 7 or 8 that you're going to see price declines. But what it means is that if you get to 18 months of inventory, like we had actually in December of 2007, I mean, we had 16,000 houses on the market and less than 1,000 sales. We had 18 months of inventory. What you're going to see there are price declines coming. And that was a very much a leading indicator for what was to happen in 2008, 2009, 2010. So back in October of 2019, it was real low. It was 3.5 months of inventory, which is incredibly low, really low. Remember, 6 to 7 months is equilibrium. Equilibrium would lead us to believe that you should see the average amount of appreciation, which is historically 4.3% each year in Jacksonville. So 4.3%, if it's at 6 to 7, 3.5 is where we were a year ago. Look at where we are at the last 3 months. In August, 1.79 months of inventory, September, 1.7 months of inventory, October, 1.66 months of inventory. You know, I started off this little conversation talking about the supply problem, and you're not going to fix the supply problem overnight. You know, and we've talked about how builders, maybe absent of a month or so because of coronavirus, have been building as much as they possibly can this year. But go back to that graph there, Pablo, for one more time.
Coming.
In Jacksonville, do you think that they're solving the inventory problem?
Doesn't seem like they're catching up very quickly. Oh, sorry, man. I'm not here.
We were so much almost on point there. I was delivering the line. That was the question. Yeah, I mean, do you think that they're solving it? They're not, right? I mean, you cannot solve an inventory problem overnight. Now, demand, you can have a big effect on demand, right? Part of the reason that we're seeing sales go up almost 30% or a little bit over 30% year over year from October 2019 to 2020 is because we made changes to interest rates, right? The Fed did what it needed to do to drop interest rates. And that is the biggest reason why you're seeing demand be a lot more, it's easier to change demand, but you just can't build the number of houses overnight that you need to have enough to support the demand. And this inventory number is going down. It's going down to almost 5,000, which is just insane. If you have been watching these numbers like I have, month over month for 6+ years now, it's just never been this low.
So talk to me about the difference between the demand that is generated nationally by low interest rates and the demand that's generated locally by what COVID has done, right? Like, I mean, there's more than one force at play here, and it doesn't affect all markets equally, if I'm not mistaken.
You're 100% right. So the demand is being driven by interest rates, but it's also being driven, especially in a market like Jacksonville, by COVID, right? People are migrating from the Northeast to the Southeast in droves. And people have been doing that for decades now. So that's not a new thing, but they are no longer tethered to their job the way that they were before. And for many people, it is allowing them the freedom to go work in a remote environment and go and live where they want to live, where they probably wanted to live for a long time. And at the same time, it's much more densely populated in places like New York and Virginia and DC. And we all know the world we're living in right now. So when you can go from a densely populated, maybe, apartment or a condo in DC or Virginia, New York, to going and buying for maybe a half of what it costs, you can get a single family home in Jacksonville, probably have a swimming pool and spend half as much, right? I mean, Pablo, you're a part of this net migration, right? I mean, talk about your story and why you came to Jacksonville.
Yeah. Listen, I came here from Miami 2 years ago. A big reason was cost of living in Miami, and the idea that if I wanted to buy a home in Miami that I would live in, I was going to have to spend about $400,000 for a home that I wasn't particularly pumped about in an area that was half an hour away from anywhere that I wanted to live. So coming to Jacksonville, it wasn't. Yes, I guess technically Jacksonville does have better weather than Miami because it's slightly more temperate. So it's even better. And it's got the lifestyle of surf and everything that I want. But these densely populated urban centers, I like how you put it, right? People were coming here already, right? Like people were coming here already, but it really took some gumption on my part to see that in the future and understand and not be afraid to move and take a gamble on changing my career. But I'm a firm believer that there's a lot of trends that COVID accelerated that were already coming down the pipe, right? Like I think the idea that we do this content stream and we are business development through, doing these Zoom calls and creating content's one of them. But another big one is the idea that you can work remote, right? Like, and companies have really learned that. So now people don't have to take this decision of, man, I really want to leave New York because I'm like living in this tiny apartment an hour away from the city on my salary because I don't want to go look for a job in Jacksonville. But now when your job is portable, it makes that decision way easier. And for the price of what I was going to get, a 2-bedroom, 1-bathroom home that I knew I was going to have to remodel in the next 5 years in an area I didn't want to live, here in Jacksonville, I get the home of my dreams and I have an extra $150,000 to spare.
Bingo. Probably
Yeah.
more.
Yeah, probably even more. And I'm like right by the beach, right? Like it's incredible. So that's a good call. I wanna take a question from Sergio right now. We already have a couple of great questions coming in, but Sergio says, so less supply, more demand, prices go up, right? And we're about to talk about pricing and where price is at, but this is a great way to frame it. We as investors are buying now at a premium, but that shouldn't affect our ROI long term if we're in it for a full market cycle. That's his question.
Mm-hmm.
To me, when I hear months of inventory are way down and it is a seller's market, right? Like you are as a buyer paying somewhat of a premium, but when you bring in this figure of months of inventory, that's a future looking indicator that yes, you may be buying at a premium, but it's not even close to the premium it's about to be, right? Is that kind of what I'm hearing?
Premium is an interesting word, right? So what people are doing right now is they're buying at market value, right? So that's what these properties are selling for today. It's the market value today. But that 1.6 months of inventory that we were just looking at, that is a future indicator of where pricing will be going absent of other things. Now, there's other things to consider. Obviously, this isn't the only thing, but this is a strong indication that pricing is probably going to be going up. So, the premium thing, we're not paying more than market value today. That 1.6 months of inventory doesn't mean that the market is overvalued. In fact, actually, the market is exactly on that trend line right now. In fact, Pablo, do you want to bring up that slide there? That's kind of appropriate right now, because this is something that is a little bit misunderstood, right? There we go, perfectly timed, right? So the market, while we're here, it's actually all the way through October of 2020, a little bit to the right of that June 2020, data line there. That is showing you that we are at 1.6 months of inventory. But if you notice that median sold price, the blue line, is almost exactly with the projected median price. That projected median price means that if our historically accurate home price appreciation played out every single year since 1991, what would it be at? Well, we're right there. So based on what our historical appreciation rate is, we're right there. So we're not overpriced. We're not paying a premium today. But what this means is that there's not enough supply to satisfy the demand. And when that happens, you probably are going to see price increases. And this is in the face of COVID. And this is in the face of our economy right now, right? We understand that there's economic pain out there, but the simple fact is that there's just not enough supply. There is a lot of demand right now. And even as we experience more in pain as an economy next year, it's not going to change the lack of supply. It's not going to change the fundamentals of the market right now to a point where you would see price declines, in our opinion. Now, what this means though, so we're not buying at a premium today. We're buying at the market value always. The market is priced appropriately based on the historically accurate projected price. It's just leading indicators that there's not enough supply. But I think a better question is, what is an investor going to find 1 year from now, 2 years from now, 3 years from now? What's the impact going to be on your future cash flows in an environment that plays out the way that this indicator tells us it's going to, that pricing would be going up, right? What is going to happen as interest rates go up in future years? They're not going to stay this low forever. They've never been this low. It's not a good thing for this to stay this low forever. So I think a good question is, what is the impact going to be to your cash flows? What is the impact going to be to your home price appreciation and your down payment required in the future when pricing does go up? Pablo, let's put you on the hot seat there. What do you see happening?
I'm glad you did that, because I was literally thinking, I'm like, okay, I was thinking through it. To me, it sounds like as interest rates go up and this pricing that's going to appreciate, the price is going to be higher and the cost of finance is going to be higher, which if I were to reverse engineer that into the investment I recently made, I would assume that that would cut into my ROI.
Exactly. Exactly.
I
It
mean, it cut into my cash flow, right? And then therefore also my ROI too.
your ROI as well. It is going to be increasingly more and more difficult. And this is not just a Jacksonville thing, or this isn't nearly as much of a JWB thing as it is for the turnkey rental investment space out there. It is going to be incredibly difficult for turnkey operators to provide positive cash flow properties in the coming years, because interest rates are going to go up. We see home values continuing to go up in most markets. We see it happening in Jacksonville over the coming years. And if you just run your evaluations and you add 1% to the interest rate, go to 5% instead of 4%, and you add, $10,000 to a purchase price because of 5% appreciation on a $200,000 asset, and you look at how slim those cash flow numbers get, that's the reality that people are going to find across the country. Turnkey rental properties are going to be really, really hard to come by in future years. And that's just the reality of it. Now, I don't want to scare anybody. JWB has been thinking about this for a long time, right? We go back a long time. In fact, even at the beginning of this conversation, Pablo, you started to ask about when we started to buy, build to rent. Why do you think we started to gobble up so much more land than we knew we were going to build and sell in that year, Pablo? Why do we do it?
Because you have the land priced in at the value that it is now, so that you can offer a property at just the construction cost, premium, not the land overall premium.
Exactly.
I just came up with that right now, right when you asked me, by the way.
Brilliant.
Yeah.
Brilliant. That was really good. I mean, that's it, right? This is what we do that's different than every other outfit out there, right? We looked at this and we said, this isn't an option for us to go out there and buy land. I mean, it is incredibly difficult to organize the amount of financial resources that we have. And we've been doing this since 2011, to go out there and buy a ton of land just to sit on it, right? We have over 600 lots that we haven't even built on. And we bought over 600 properties just this year. And so we've been doing this and doing this and doing this. Why do we feel like we are in such a rush to do this, whereas other people are just trying to solve the problem of how do I get supply enough for my investors today? Well, it's because if you're not thinking 2 years ahead and don't have a runway of inventory 2 years, 3 years from now, these turnkey operations are just flat out not going to be in business anymore if they are just trying to sell existing renovated properties for cash flow, because interest rates are going to go up, home values are going to go up, and it's no longer going to be positive cash flow for them. So we're good. We're good in JWB. We've been planning this since 2011. We have plans next year to buy more lots than we're going to sell next year again. And that is there for our clients. It's to protect our clients. It's to protect our business. This is where it's going.
That's pretty incredible, man. So like, as you're saying all these things, I'm thinking, okay, so if I am, again, and this, I hadn't really thought of it like this when I put down on the property that I just put down on, but if I'm on the fence, I'm thinking, then it's time to move, right? Like if I'm on the fence, I'm thinking I want to invest in a rental income property ASAP, because right now, no offense, but right now there's options, right? Like it can be JWB or it could be somebody else, because people are still afloat. So at least I have an ability to choose. I also think that soon it's going to be the big guys only, and only the best ones that have planned ahead of time. So therefore, if I want to do it and build a relationship long-term, I would be thinking, okay, that gives me a nudge towards investing with JWB. And 3, I'm also thinking the longer I wait, the less returns I'm going to have later on anyways, right? So like I'm just kind of like breaking down what you're saying as a consumer, but I'm thinking urgency in the sense that, yes, it's going to be there down the line because you have planned for it, but the deal's not going to be as good for me later on, even though it, depending on whatever it is, it's still probably a good deal.
Yeah, the returns that we're able to generate today are better than the cash flow returns that we're probably going to be able to generate
Yeah.
a year from now, 2 years from now, 3 years from now. Because there's no way that we could be good enough in an environment where prices are rising and interest rates are rising. There's no way that we're going to be able to be good enough at dropping maintenance cost and vacancy cost enough to offset that, right? We try, we are maniacal about that. But the reality is that property taxes go up, right? You know, and all these forces are going in the direction of lower cash flows in the future. This is the same message that we gave in 2014 to our clients and 2015 in our clients. We said, hey, in 6 years, we're going to be talking, you know, in 2020, we're going to be talking and you're going to be kicking yourself because you didn't buy more assets now, right? This is the same conversation that we're going to have years down the road in 2020. And the property that you're buying, Pablo, you're going to look at and you're going to say, man, 4% interest rates. Oh my goodness, this is insane, right? Like, I wish I would have bought more. So I think the best thing is a lot of this comes down to planning, right? In order for you to figure out exactly what the right amount of properties for you to purchase is in your portfolio, we need to have a plan. That's what we do with our clients. We sit down and we map this out. And that's the reason that we do it. Because a lot of times people will come to us and they'll say, you know what, I have this pile of money over here that I want to put into rental properties. And I'm thinking that I want to buy 2 a year for the next 5 years. And we break this down and we show them, okay, this is really what that's going to equate to, right? If we buy 2 a year for the next 5 years, that's going to get to your goal as far as cash flow, but that's only if the assumptions don't change, right? You're making your plan. You're coming to us with your plan based on everything staying the same for the next 5 years in the market, but it's not going to. So now let's look at how can we change this plan? How can we maneuver this plan to use that same pile of money that you have kind of earmarked for rental properties and implement it in a way that you can take advantage of a low interest rate environment, right? Or implement it in a way that we can limit your down payment. And for a lot of people, instead of doing that two over the first 3 years or 5 years or whatever it is, I mean, it is clear there is such an advantage to getting in and buying, using that same pot of money and implementing it now because of where we are in this asset class, that it will make a ton of difference for your overall return on investment and really will decrease the number of years for you to get to whatever your passive income goal is. It's just that planning, working with a team that literally manages $450 million in assets like this. And we can show you, it's not about having to invest more than you were originally thinking, right? It's just, how can we help you plug and play that in and do that to generate a better and a more efficient return on the investment?
I mean, that makes a lot of sense to me, man. I want to I know that we're coming up on, we've got some questions I want to get to, but I definitely don't want to come away from this without talking about the JWB rent collection numbers and that state of the market, right? So
Yeah.
you want to tell us how rent collection is doing, how many property, you know, how that piece is going?
Yeah, I can do that. Let me just show them what the numbers are on pricing, because I know we had a couple of questions on pricing overall. Let me just show you guys where the pricing is so you can keep it in mind. And you know, obviously, this is the format that we do every quarter. So you guys will see how we do this when it comes to Q1. We won't spend so much time on this, but you can see October 2020, our median home sales price in Jacksonville is a little bit over 262,000, which is way below the U.S. median. The U.S. median is actually just about 325,000. So when you're looking for a market to invest in for cash flow positive properties, it helps to be that far below the U.S. median, and that's where we are there. And then another data point there: 6.24% appreciation year over year. That's significant. That's more than normal, and the historically accurate appreciation rate's 4.3%. So interesting to note there. That's what we're seeing. Prices have been going up, and this is actually over the last 6 months. We actually smooth out the data over 6 months so as not to have too many monthly kind of ups and downs. So 6.25 is where we've been for year over year appreciation.
Man, the thing that really popped to me when I saw the statistic is the idea that, you know, the the pricing has gone up, but the number of sales that are happening monthly has increased by a factor of 30% as well, right? Like that to me is really eye popping. Um, and that's going strong. And it's quite frankly pretty shocking to think that even with all that rapid growth, we're still so much lower than the national average in pricing. Like that's
Absolutely.
incredible to me, especially living here now and knowing how amazing the lifestyle here is now.
Yeah,
Like it's like the best kept secret, right?
exactly. Exactly. And for pricing, don't be surprised in the coming months if when I'm reporting this for you guys, that the median home sales price will go down. It's very normal when you get to November, December, January, as the months are colder, you get around the holidays, people buy less houses. So don't take that as a sign that somehow the market forces that we're sharing here are not ringing true. It just happens every single year. And then you'll see a rebound as we get back into spring.
Okay, let's talk about rent collection, man. How's rent collection doing?
Rent collection strong. Rent collection is really strong. It's such an incredible testament to our residents, to our team. In the face of coronavirus, we've kind of sang this tune for a while now. As far as you're in a place where people are struggling out there, and you're also not able to evict, and so it creates an incredible challenge for us to to work with folks to get them to pay the rent. But our team, based on our relationship with the residents and based on just a team that's really overcoming a lot of obstacles, we've continued to perform. So put the numbers together here. And I chose, if we look at the top there, February 2020, our rent collection number was 98.5% of rents collected in February 2020. That was before really the world changed. And 98.5% is our standard on a monthly basis of rent collection. And every month since coronavirus broke, we've been over 97%. And I chose September, October, November, the last 3 months here. You can see September of 2020, we were 98%. October, we were at 98%. And then, I wanted to be very particular. I didn't want to give us that extra 0.1%. So in November, I made sure I noted there that it's 97.9%. So you can see 98% basically is where we've been for the last 3 months, and really, really incredible. And this brings consistency to the asset class. This is why you're probably thinking about investing in rental properties. You're probably, fed up with the variability of the stock market. You want something that's going to produce monthly income. It's going to produce consistently. Well, here's how we do it. This is what that means. So we take a lot of pride, and we have a big responsibility to deliver really high rent collection numbers like this.
Yeah, and as a participant on the show and as an observer on the show, when I see the rest of these statistics, right, when I see the 3,674 properties under management, the fact that you've rented 1,022 houses in 2020, the average, the average duration 26 months, percentage of re-signs being 72%, current occupancy 97%. I hear a lot of the things that we like to key on here. The number of properties under management being 3,600, showing off why you are able to provide your own data that is market specific, because you have so many data points that you can really validate a data and share that information and it be true. Like, right, it's not just 100 houses that you're going off of. The idea that you have rented 1,022 homes in 2020 tells me that you are really, really keyed in on what the pricing and demand and like expectations of a tenant or a resident, as you call it out there. The idea that you have this average duration of 26 months in a lease brings home the 2-year plus lease, that you stick to, right? Like 2 to 3 years is what you sign people under, right? Like the proof is in the pudding here, right? The 72% amount of leases re-signed tells me that you are taking those active measures to lower property turns, which at the end of the day is the biggest killer on ROI. So it's really, really encouraging to like see these numbers up front after talking about it for so long. The other thing that I wanted to bring up earlier, because I wanted you to get to this slide, is when you were talking about how you were telling people in 2014, you're not going to get this opportunity again, and that you feel like you're saying the same thing. To me, the first time I heard that was when we brought Richie on the podcast as the VP of mortgage for SunTrust. And he put it that way, right? Like that's when we first started hearing that message, the idea that this historically low mortgage rates have created this opportunity to be like, no, no, no. Right now is the indicator point that you are at this historical opportunity, not bottom of the market in pricing, but bottom of the market in interest rates and top of the market for ROI moment right now potential, right? Like, and we've been hammering that home now. I mean, Rich's show was like 3 months ago, 4 months. I have no idea. I can't believe we almost been doing this for a year, right? Like,
I know, right?
Rich's show was like 4 or 5 months ago, and that's what really started getting my behind in gear to be like, I need to take advantage of this thing, right? So like, it is pretty remarkable to continue to hear that message, and I repeat it because it was so valuable to me, right? Like it was so valuable to me to hear, okay, historical opportunity. I've heard that maybe once or twice in my life. I'm 40 years old. This being the second or third time, it's about time to move, right?
Yeah. I mean, you're 100% right. And Rich has continued to act on what his beliefs are, right? He's continuing to add to his portfolio. And I was talking to him the other day about it. And he's like, listen, I've got my plan. I know how many properties I need to get to in order to achieve my passive income goal in 10 or 15 years. And I'm taking that pile of money that I had planned to put into this, and I'm fast tracking it to rental properties because of what you just talked about, right? The deal is the debt right now, right? And so the ability to do that is going to have a huge impact on decreasing the amount of time that he gets to his goal. And the cool thing too, for our friends that show up on our Thursday show, whenever we do our property of the week, I'm recommending that property. And the first thing that I bring to you guys is I say, let's look at the return on investment here, because the return on investment is how you need to make your decision on what property is the right property for you, right? Well, we have seen prices go up over the last few years, but our return on investment, you would think as prices go up, then your return on investment would go down, right? Because your payments are higher if you keep everything else constant. But Pablo, what were our estimated returns on investment before coronavirus?
7 to 9%.
7 to 9%. Prices you guys have just seen have continued to go up. But what are our estimated returns on investment now?
9 to 12%.
Yeah, 9 to 11. Thanks. I know you're trying to get the extra 12. I got
it. Listen, the one that I got was 11.97%. So
there you go. It can happen. And it can happen every once in a while too, especially if we over rent a property as well. So, but the big thing here is that we've seen prices go up and estimated returns on investment going up. That's not normal. Normally, when prices go up, your estimated return goes down. The biggest change has been the interest rates. Our interest rates were estimated probably at about 5% before. Now they're estimated at 4%. That instantly adds 2 points to your investment, estimated return on investment, even while prices are going up. So the big takeaway here is that is incredibly impactful. It's not going to stay that way for forever. It's really not. This is still going to be a great asset to invest in 5 years from now when we're doing the show and we're talking about it. But I'm not going to be talking about how it's a once in a lifetime opportunity from an interest rate perspective and how impactful that is. That's just where we are.
Yeah, that makes a lot of sense, man. I mean, when I talk to, anybody that doesn't know, Rich is one of my best friends, right? And when I was talking to him about it, and he was telling me how many houses he's bought, I'm like, yeah, man, because you're my boy and you're like a fan of the show. He's like, no, dude, no, it's the interest rate. Because I'm like arguing to him. I'm like, all of the sales that you have gotten should be credited to the fact that I'm doing this program. And he's like, no, dude, it's the interest rate. All right, Greg. So let's get into these questions, man. I know that you have a really, really hard stop at 1:30. So let's get into these questions. If you got to go, I'll wrap up the show, but I want to give value here. Right. So, Cecile Jamay asks, this was what we were talking about, the supply. She asked that I read the government help and programs are expiring by the end of the year, which leads economists to believe that we're going to see a flood of foreclosures coming on the market, which is going to increase significantly the supply. What are your thoughts on that?
Well, I think that when we do see the stimulus We have seen the stimulus stop. We have no idea if it's going to be another round. It really doesn't matter. Let's take the worst case scenario. Let's say that there's no stimulus and that the eviction and foreclosure moratorium is removed. You are right that you're going to see a flood of evictions and you're going to see a flood of foreclosures. I think anybody would agree with that. But the thing to keep in mind is we need to keep perspective. Okay. One thing to track is the percentage of sales that are foreclosures. If we go back to 2007, 2008, well, actually, if we go probably back to 2010, 2011, 2012, the percentage of sales that were foreclosures was over 40% in Jacksonville. And when you have a foreclosure sale, that's a distress sale. So that decreases pricing. It's a pricing decrease. It's going to decrease prices if you have 40% of your sales doing that. Now, and this was prior to COVID, it was like 2% in Jacksonville. A normal market is somewhere around 10% of all activity would be foreclosure sales. So, our thoughts are that you are going to see more foreclosures, but you have such a runway before you get to 10% or even more than that. And if you look at still the other dynamics with the low supply overall, that we don't see it dropping prices, even though you are correct, and that you're going to see foreclosures increase.
Yeah, and that doesn't affect the demand side either, right? Like I feel like we've shown a lot of things here that say that there's such a hefty demand that provides a little bit of a floor for, what foreclosures can possibly do, right? Like it's going to be the foreclosures kind of like we were seeing in 2014, 2015, where foreclosures get snapped up in a second because everybody knows what the deal is, right?
Absolutely. There's investor capital. The big guys all have the capital ready to invest. Another something else that you're probably not reading about out there is that servicers are different this time. Servicers who are basically institutions that would take the properties back, banks. Let's just say banks, so I don't confuse people with the servicer terminology. In the past, banks would foreclose on a house and then put it right back on the market. It would become a foreclosure. And then another operation would come in and buy that property at a discount. Now, because of the price increases, the environment that we're in right now, and because generally we've seen a lot of appreciation over the past 5-8 years, there's more of an equity spread in there. Banks will actually take the property back and are actually renovating the property while they're owning it. So that doesn't hit the market as a foreclosure sale. That hits the market as a sale. Maybe it's a slight decrease to market value, but it's not 50% of market value. So if you see that in mass as well, we believe that there's going to be less impact on each of these foreclosures because banks now see a way they're actually very prepared for it compared to when it happened in 2008. They're very prepared and they see it as a way to be able to maximize their return by actually renovating it and put it back on the market themselves.
That's super interesting, right? Like the idea that it's happened in the same career span of the person sitting at the bank shows that they're not going to just get sucker punched by it, right? Like in 2008, I was 28. Like that hadn't happened in my lifetime, right? Like this is too recent. Like the person sitting as the mortgage lender in the bank has probably flipped a couple properties in 2011, right?
Yeah, and he has a runway to be able to get his team together. I mean, we know that the economic pain from coronavirus has not fully been felt as an economy yet. So they're preparing for it and they're going to maximize their returns on it, which will provide more stability for the market overall.
Super interesting point, man. I never thought about that. All right. Lee Bishop says, I have a question to the man with the plan. I think that's you, Greg. How much are you cutting into empty lot properties that JWB owns to fulfill the uptick in sales for JWB investors right now?
0. Our plan is to buy today for the future runway for clients just like Lee. And so we are not at a point where we have to basically take away from the excess lot inventory that we've built up over many, many years. We don't have to dip into that yet. We've never had to. And we don't want to. We're going to continue to buy more than we need to build this up so that we're going to be able to provide this runway for clients for a long time.
Yeah, so you're the only game in town. All right, Marilyn Cotterman from Homosassa, Florida.
Home of the manatees, baby.
Asks, approximately how many new builds does JWB have available to sell to investors each month?
We build about, this year we built about 300 properties. So call that about 25 a month on average. Next year, we're going to build about 450 turnkey properties. So it'll be, call it 40 a month. And then we sell typically about 40 a month overall. So that's kind of where we're at in a normal environment. We've had some slowdowns on the new construction side, mainly resulting from COVID related issues. And so it's a little bit light on the new construction side right now, but that's really temporary. I mean, at any point, if there's new construction properties that you want to focus on, give my team a call. We have new construction inventory right now. It just might not be 25 this month. So.
Gotcha. Roger Evans asks, does the 1,022 rented homes in 2020 include ones that were re-signed by renters?
That's a great question, Roger. That does not include re-signs. I'm glad you asked that question. So 1,022 homes are just new residents that sign leases with us, either 2 or 3 year leases with us. The residents that renew is actually the line below it. We don't need to go to it, but it's 72% of leases that have ended this year in 2020 have been renewed, which is incredible. People, it's good to focus on the new rent number, the number that's been rented, because that's important. We need to fill your home. But as you're more and more of a seasoned investor and more and more of a seasoned JWB client, you're going to get more excited about the re-sign call that we give you and let you know that your resident was re-signed for 1 year, 2 year, 3 years, because that's us deferring $2,000, $3,000, $4,000, $5,000 of costs that you do not have to pay, either in maintenance fees to get the house back into rental shape, costs for your mortgage to cover while the home is vacant, and tenant placement fees. You save thousands by us renewing those leases. So I appreciate you bringing that up. That's incredibly important in our strategy for you.
I'm very much looking forward to that re-sign call, man. I feel like that re-sign call is kind of like cha-ching, right? Like that's just like an ROI upper.
Exactly. Exactly.
Cool. That's cool. All right, Mike Foster, final question, Greg, and then we can get you on your way. I'll do the goodbyes for everybody. Mike Foster asks, just curious why JWB limits Jacksonville housing market appreciation analysis to a range of 1991 until today. He's looking at the Federal Reserve Bank graph showing Jacksonville housing prices going back to 78. And even since that year, there's been a steady appreciation. That length of time would show 2 full real estate cycles.
Yes, and you're right. So I thought a lot about, when I was doing the research, which source was I going to use as our source? And because, I'm not just trying to get data for Jacksonville, I'm trying to get data compared to our other competing markets out there. And when I looked at the Federal Housing Finance Agency site, of course, I wanted to have one that everybody had trust in. And when you look there, they give analysis, really, they give it farther back than 1991, but it's not very consistent. Even in Jacksonville, they give it farther back than 1991. It's hit or miss, it's spotty. From 1991 on in Jacksonville, and compared with all of our competing markets out there, Memphis, Kansas City, Birmingham, Dallas, Cleveland, a few others, the data's all there, and I have a lot of confidence that it was done consistently quarter over quarter. So that's why I chose the Federal Housing Finance Agency site. The other site, I think the data, as you mentioned, is very similar if you go out full market cycles, which is the key. And Mike gets this, that real estate cycles tend to repeat themselves over time, right? If you give it a full market cycle, you can bank on the historically accurate appreciation rate being pretty darn close to what you're going to experience. So very cool that you looked at another resource and really a longer time span and came to the same conclusion there.
I got one last thing that Sergio wants to get in here. He says, go Gators.
Go Gators. Sergio is my buddy. Sergio is a new client and a friend of mine from college, actually. He is a Gator. Man, how about them Gators? What a win, huh?
Gators are great. He also puts Go Dolphins in there, and that really freaks me out because I feel like the cursed Dolphins fan. Like I'm still waiting for the bottom to drop, but it feels like we're in a really, really good direction of good coaching. And I don't want to talk about it, man. It freaks me out.
Good for you guys. You guys have been fighting the battle for a long time. My wife is a huge Dolphins fan, and so I want to support my wife, but I mean, on Steelers Sundays, we know how my kids are dressed on Steelers Sundays. Let's just leave it at that.
I heard your team's doing okay.
9-0, baby.
Gregg, why don't you say your goodbyes to everybody, and then I'll just kind of tell everybody what's going on afterwards, and where to find us in between calls, so you can get going to your engagement.
Awesome. Thank you, everybody. Thank you for being here, Pablo. Awesome session today. Appreciated all the really insightful questions. This is one that I would certainly encourage you to watch again. And the best way to do that is in the watch party that I host every Tuesday night. It's a really cool little session there. A lot of folks, I know I see Marilyn, I see Lee there, I see John Henning there. I see a lot of our regulars that join me in the watch party. And I'm there to answer any questions that you may have. So hope you all will join me. It's in the Facebook group, which I think Pablo's throwing in the chat there. There we go, jwbfacebookgroup.com. Go there. We'll approve you to get into the group. And then at 9 o'clock, you'll get a notification, and you can just jump right in, and we can do this whole thing over again. So thank you, guys. Thank you so much, Pablo. Awesome job today, brother. I'll catch you on the next one. Okay.
Good job by you, buddy. And I want to thank everybody as well, right? Like it's never fallen on deaf ears by me or by Gregg. The fact that 40 people join us in the middle of your day, it's really an unbelievable thing that we get to spend this time with you. I feel remiss to say go Dolphins without talking about Marilyn Cotterman, having been a 1972 Dolphins cheerleader. I think that's pretty much the coolest thing ever. So Marilyn, I think that's amazing. And again, if you want to hop on a call with the JWB team, just talk about that plan, talk about how this, historically low interest rates and these rising prices can fit into your portfolio in an intelligent fashion. Go to chatwithjwb.com. If this is your first time on the call and you're still here, amazing. Happy to have you as part of the group and part of everybody, showing up every week, like Leo, like Bill, like Lee, like Madge, Marilyn, Sergio, Jane, Bill, everybody that's been commenting here, that's saying thanks for everything. It's so good to see everybody. So if this is your first time, we hope to see you again. And the next one is going to be on Thursday at 12:30, where we do our property of the week. Normally I do an inflection in my voice where I go, JWB property of the week. And Gregg does like a fake echo. I'm not doing that right now because he's not here. Wouldn't be fair to him, but I hope to see you there. And in between, join our Facebook group, right? 1,800 people strong. Watch the watch party. Make friends with us on Thank You, Lee. Week. Join us in the Facebook group. That's where Gregg does his watch parties. That's where he does his walk and talks. That's where we all interact, right? Like a couple people from this call, I'm already friends with you on Facebook because we're in that Facebook group together. I've had a couple of new friends on Facebook. Happy to connect in any way that we can. So thank you all for being here. See you on Thursday. See you on the Facebook group. And I hope you have an amazing, amazing rest of your week. Take care.